So I think I've seen a lot more in our portfolio companies using equity mostly as a retention mechanism for their top performers and less of a universal expectation for their entire teams. Have you seen that, and are companies doing that in different ways?
Yeah, undoubtedly. I think there used to be this perception in Silicon Valley or in tech where if you're an engineer or an employee at a company, you're owed a refresher grant just for existing at the company. And that has basically been thrown out the window. You have to earn it now. You have to be a top performer to get refresh equity.
Have companies moved away from just tenure-based refresh grants and towards performance or towards, promotion grants, or has how has that shifted?
The word that I often use is equity eligibility. Who is eligible for a grant? In particular, a refresh grant is where you can be a little bit more experimental. And there's a few different dimensions. One of them is by performance, which you're alluding to. Companies have gotten stricter about only giving refresh equity to employees that are performing above a certain bar. Other dimensions that companies are experimenting with include job family, maybe just giving it to R&D and not to the rest of the company. Another dimension is level, only giving it to more senior people. And then another dimension is by region. A lot of companies historically just gave equity to everyone around the world, but due to cultural differences, due to legislative differences, it's not as impactful to give equity in some countries. And so some companies are saying, in a world of scarcity, let's give it to who will appreciate it the most. And we're seeing a decrease across the world.
One of the things that we've seen a lot more of with startups these days is as valuations have gotten crunched and SaaS multiples have come down, companies have been forced to be a lot more judicious about where they apply their equity. How is that changing where that equity ultimately ends up going?
Yeah, well, I think it's valid or important to set the backdrop, which is all around equity burn rates. And just to take a step back, if you look at public markets, stock prices are down based off where they were at during the high, based off SaaS multiples, based off many other metrics. And so companies often pin the value of an equity grant to a dollar amount. So if I was going to give you $10,000 worth of shares and the stock price halves, I have to give you double the number of shares. So equity burn rates are up for companies to sort of stay on par. And thus, they have to bring down the equity burn rate to make the board happy, to make investors happy. And they have to do more with less. It's a world of scarcity. The pressures of scarcity are stronger than ever. And so it's really tight right now. Yeah. And they're being judicious around how to spend that equity.
Yeah.
Have you seen that in your portfolio? Or?
Yeah, it seems like everybody's shifting from equity being just something that everybody gets to, we're going to use this to retain our absolute top performers. It's probably more senior people. It's probably people in job families that are harder to replace with AI or, harder to come by in general. But I know that there are a lot of mechanisms for how companies think about this. Are there other frameworks that you've seen?
Yeah. So there's two types of equity, really. There's equity that you give to new hires, and then there's equity that you give in a refresh sense, either for promotion, for performance, for tenure. And the latter has more experimentation, I would say. You can just pull more levers and more quickly see the results. And so the way I've seen companies think about it is across four dimensions. One of them you hinted at, which is by performance, right? Companies are saying, you don't just get refresh equity for existing at the company anymore. You have to earn it. You have to be a top performer. And then the other four or the other three that I see include by level. A lot of companies are saying, yeah, we're only going to give refresh equity to certain levels and above. You hinted at that with the job replacement point. The third is by job family. Companies are saying, well, what are the most valuable job families that we absolutely need to retain for our business? And then the fourth is by geography or region. In certain countries, even parts of the US, equity is not perceived to be as valuable. And sometimes there's tax laws that make it tougher to receive equity. So companies are saying, in that world of scarcity, we're going to be a lot more judicious around who is even eligible to receive equity.
Does looking at that data of geographies or job families and who is less likely to kind of need equity in order to bring those people on board, does that influence hiring plans for your customers?
Yeah, definitely, from two perspectives. One is the raw number of hires that they're making, and then the second is where to hire.
There's been a lot of chatter over the years about changing the structure of how equity is granted to employees. It's something that I really haven't seen until the last 12, maybe 18 months, that companies are experimenting with either shorter vesting cycles, back-weighted schedules, boxcar grants, like all these different new ways of looking at it. Do you have a perspective on where that comes from or why that's happening now?
Yeah, I mean, it makes sense because we live in a world of extreme scarcity right now with equity. And the backdrop is equity burn rates being high, boards pushing downwards to keep equity burn in control. And meanwhile, companies still have to figure out how to retain their top performers and attract technical talent. And so there is no other choice but to experiment. And so all the things you mentioned, back-weighted, front-weighted, shorter vesting schedules, equity eligibility we talked about, these are all the levers that companies are now pulling in real time to see what happens.
It seems to me that that's being driven from the public markets down in tech. It seems like startups outside of the norm are slower to innovate on that front. Do you have any idea why that is or if that's true?
Anecdotally, I would agree. I've seen more rapid experimentation with equity programs for public companies, private companies being shortly thereafter. I think the reason is because if you're a public company, there's a real-time stock price.
Yeah.
And so any fire that exists is acutely felt by the second.
Yeah.
Every employee is looking at Yahoo Finance every morning with their cup of coffee to see the stock price. And so the fire is burning in a visceral sense, and companies have to fix it ASAP, both the equity burn fire and also the employee retention fire.
Yeah.
Imagine if you're a company where your stock price went to 10% of its all-time high. That is a huge, huge challenge from an employee retention standpoint.
Especially when they mostly give it on gross value instead of the way private companies do it, which is largely percentage based.
Exactly. The typical public tech company will say, here's your dollar grant value based off the trailing 30-day stock price before you join. So if the stock price is super volatile, it's so difficult to plan.
Yeah.
The craziest example I've seen is one of our customers. They have, I believe, 4 different grant schedules. They give 1-year grants, 2-year grants, 3-year grants, and 4-year grants for all the different purposes, for refresh, for performance, for tenure, for new hire. So there's a lot of experimentation right now. But for private companies, it's different. So I'm curious what you're seeing in your portfolio. For private companies, there are many challenges. It totally depends on if the company raised a big round at a big valuation and then had to raise a down round, or is running out of capital, or maybe they are one of the lucky few that has raised a new up round and are one of the only companies hiring. It's just all across the board.
Yeah.
But it's difficult because equity is opaque for private companies. There's no real-time reference price. And so some companies price by percentage, some do it by the most recent preferred, some do by the 409A, some do by some other valuation methodology. It's just a complete mess right now.
Yeah.
What about your portfolio companies? How do they usually communicate the value of equity?
Yeah, I think as the pressure to reduce equity burn has risen, one of the things that we've seen more of is using a shorter cycle allows companies to communicate the same value to candidates on a yearly basis, rather than just saying, hey, here's your 4-year grant. They're saying, this is how much you're getting every year. And that's kind of the allure of boxcar grants or 1-year cycles or 3-year cycles is they can budget more effectively how they use that equity while still maintaining the communication to the candidate pool of how much they're actually ultimately going to make.
Makes sense. The typical Silicon Valley software engineer is always asking, what's your TC? What's your TC? And that's an annualized number. So definitely I'm seeing that. An additional argument in favor of a shorter vesting schedule for new hire grants is that the company will get more optionality over time to decide who to double down on, who to give crazy sums of equity to. Yeah. So a big trend right now in the market is pay transparency. Anytime I talk with a compensation or rewards leader, it's all about pay transparency. A couple of things. One, usually it's talking about salary. I've seldom met a company that also is posting equity bands in its job description. So really what people are talking about is salary transparency when they say pay transparency. And the second thing I've learned is that most companies want to be transparent, but it's really difficult because they're afraid of opening the floodgates. If they had the structure in place, if they had their compensation philosophy in a consolidated format, they would be transparent, but they're just afraid because of messiness accrued over the years.
It seems like candidates are not just better versed with salary data, but they know more about equity as well. Has that been different with how transparency has been handled by these companies?
Well, there's this other force related to equity data, which it matters in particular for private companies, which is we had crazy valuations in the last boom. The question now is what is the reference price for a company? How do you value an equity package? And I think that makes it even tougher to communicate the value to employees and candidates, and makes it even tougher to be transparent.
We looked a lot at job postings and where they're going as kind of a leading indicator for where salary data is going to go and how jobs are going to grow or shrink. It was very interesting to see that job postings themselves are up 30% in the last year.
Wow.
But at the same time, we have skyrocketing rates of applications per role. So even though there are more jobs, they are arguably harder to come by.
Interesting. So do you think this means we're out of the SaaS recession, or?
I think it means we're trending that way.
Okay.
I think it means there's going to be a lot of attrition in the second half of this year as people start to change jobs more frequently.
Right. Certainly lines up with what I've been seeing. What about by job family? Are certain roles hotter than others?
Yeah, I think, support has been an obvious one. I think AI has affected that family a lot, and they have moved into definitely the worst hit by salary changes year over year. They've seen the most applications per role of any job family. But there's a lot of nuance to which families are moving in which direction. So it's been really interesting to dive into that. Another thing we've seen a lot of is companies grappling with employee confidence and employee engagement. And, employee confidence specifically is at the lowest point we've seen in at least 8 years. And I think that's due to a variety of factors. But the employee engagement side, I think, is largely driven by remote work. I think those are the employees that are lowest on engagement and trending lower as time goes on, and they push back on RTO mandates and things like that. What are you seeing for confidence and engagement and stuff like that?
Well, yeah. I mean, first on the note of confidence, my theory is that it's largely macro driven across the board. I think Redpoint has even published some benchmarks around growth rates, around NDR, around GDR, around the key financial metrics. We're just not where we were in 2021. And, they say revenue solves all problems. And if revenue growth is slower, I think there's just going to be more anxiety felt across the board, and that will bleed into confidence. It will also bleed into engagement.
Yeah.
Now, on the note of engagement, you raise an interesting point around return to the office. It's almost a bit of a catch-22, because you mentioned that remote workers are feeling a little bit less engaged. Yet meanwhile, they're probably pretty upset with a lot of your portfolio companies that are mandating a return to the office. And so it's really tough. And so, my theory on remote work or in-office policy or RTO is that companies need to be very proactive and deliberate around what their philosophy is.
Yeah.
It's really a game of expectation management with talent.
Yeah.
And so the one real danger mode is when you're flip-flopping. And of course, a lot of companies flipped one way during COVID and are flopping back another way now.
Or making exceptions for people, because that's seen across the team. And we see a lot of that. If we have this really great engineer, can't get them to leave Nashville, but we want to bring the rest of the engineering team in. And how do we handle that? How do we unwind the policies that we put in place the last few years?
Right. It gets extremely difficult. What I can say about Pave is we've always been proactive in our belief in an in-office culture, and we look for candidates who want that. If we have a candidate who does not want the office, I still respect that candidate, but they're probably a bad fit for our culture.
Yeah.
And so that's what I encourage companies to do. Be proactive and to the best of their abilities, be consistent. I know it's tough when you have that engineer in Nashville who wants to stay in Nashville and you really need that engineer. But you just accrue a lot of cultural debt by making all these exceptions.
Yeah. And I think it's been interesting also just in the last year, maybe year and a half. I think understanding the positives of remote work is very easy. You can see that on day one. You can hire anybody anywhere. You can, people can work hours that work for them. They don't have to commute, things like that. The long-term negative impacts of having a remote culture when you're not set up that way from day one are much harder to kind of latch on to. And so it's taken companies a year, 2 years, 3 years to catch on to like, hey, we really aren't as productive as we used to be. We're not collaborating as well as we used to be. We don't have the culture we used to have. And so unwinding that has been a really big question that we've been getting from portfolio companies.
And I think related to that, another danger mode is if you're in the gray zone where you're kind of in office, but kind of remote. And, anecdotally, I have a lot of stories of friends at companies where they want you to come to the office 2 days or 3 days a week, but they don't really define which days those are. So you'll come in on a Monday and your coworker is working remotely that day. You don't see them and you're in Zoom rooms all day long, but you're in the office. And so that's the danger mode.
Yeah.
So I think companies just really need to be disciplined and principled about whatever direction they choose.
Yeah. Anecdotally, I think I'm seeing a lot more companies from day one say we are an in-office company. We're not hiring remote. And these small startups where people need to be really nimble, they need to collaborate really well. I think I've seen more of our new investments build in a purely in-office environment.
Very interesting. Yeah. I mean, there's the founder perspective of why even hire remote. You hinted at it. And I think a couple of years ago, before kind of the markets crashed, so maybe 2021, it was all about hiring velocity. Boards were saying, we just gave you all this money. You need to hire engineers faster. And so companies were just hiring. And to your point, hiring around the world is the fastest way. To the companies today that are hiring remotely, I think it's more about cost savings. I think it's looking at those geo differentials in places like India or Eastern Europe or parts of LATAM and taking advantage of that so-called wage arbitrage.
Yeah.
So it's just a different interest today. If you go back before COVID, before the whole remote work wave, there was a typical sort of understood benchmark in compensation, which is that from tier 1 markets like San Francisco, New York, et cetera, to tier 3 markets in the US, there was roughly a 20% decrease in salaries. Of course, it varies by job family, by company stage, but roughly 20%. And we've been through a lot the last 3 or 4 years. We went through COVID, a market crash, a market recovery, a great wave of hiring, remote work, another market crash. And now we're sort of at the end of this so-called SaaS recession. And well, the wage gap today is more like, 11 or 12%, depending on how you look at it. So there's this question of how did this compression happen? And it really comes down to companies' philosophies. Late stage companies, public companies, they basically are entrenched in this philosophy of we're going to have different geographic tiers within the country and around the world. We're going to pay tier 1 talent this rate, tier 2 talent this rate. But all of the wave of startups that were founded during COVID, raised large rounds during COVID, the vast majority of them pay the same amount anywhere and don't have these conventional geo tiers. Yeah. And so if you're, an engineer in Idaho, why would you work for one of the companies that is going to penalize you? You'll want to work for the company that's paying the San Francisco rate for that Boise, Idaho engineer. And this is a key force that has sort of compressed that delta between tier 1 and tier 3. So at least that's what I'm seeing in the cash world. What are you seeing in the equity world?
Yeah, I think on the equity front, it's interesting. So I've been with Redpoint for about 6 years. When I started here, the general idea was employees should share in the profits of the company regardless of where they're located. So equity should be by and large the same regardless of what location you're in, and you kind of vary salary based on cost of living and things like that. It's been really interesting to watch how quickly the equity has dropped for tier 2, tier 3 international geographies. It's down to, if you hire an engineer in a tier 3 city, you might be able to give them half the equity that you would if they were in San Francisco. If you hire them in, Bangladesh, you might be able to give them 20%. It's pretty surprising how big this delta has gotten.
Yeah, that's really interesting. It's much bigger than the cash delta. And I think it's due to a couple of key forces, some on the supply side, some on the demand side. On the demand side, there's this cultural thing in Silicon Valley where everyone has that, friend of a cousin of a brother-in-law that got rich from, the Uber IPO. And that density of stories just doesn't exist outside of really San Francisco and New York to an extent. So part of it is cultural. People just don't value equity outside of this Silicon Valley bubble, especially in international locations like you mentioned. And then part of it is on, the supply side. And what I mean by that is around the world, there's a lot of different laws around equity. And some countries make it really difficult for employees to receive equity. There's 1 or 2 European countries in particular where if you receive equity in a private company, it's an illiquid asset. You can't just sell it. You get taxed upon the grant date, not even upon the vest date. So if you're an employee in one of these countries, it's really difficult to even receive the equity. And companies are acknowledging that. They're embracing that. And they're saying, it doesn't make sense to give equity to these international employees. So yeah, I think it comes down to those 2 key forces.
If any of this was interesting to you, check out the full Redpoint Radar report. It's on redpoint.com. We put months into this and looked at a lot of different data to give you some unique insight. So we're looking forward to hearing what you think.